Hey guys, welcome back to the channel. In the first part of the video series, we discussed the supply and demand zones in greater detail, from identifying, drawing, and trading these zones. In this video, we will fine-tune all what we have learned to make a proper setup with a higher probability of success and a better risk management. In that sense, we will talk about the odd enhancements and the scoring of these supply and demand levels. So in order to trade the market with supply and demand strategy, you must use some essential odd enhancers to help you select only those zones that have a higher probability of success. Remember that not all supply and demand zones work. You can't just buy every demand zone and sell every supply zone. For that, you need to learn how to filter them properly using odd enhancers to evaluate your zones. So basically there are 21 odd enhancers that have to be considered. But all of them are not important to make a note of. But I will still post a link in the description of this video if you want to learn more about it. In this video, however, I will talk about 5 important odd enhancers that you can make use of. This will definitely increase your odds of success and minimize your potential losses in the market. If you have been trading the markets using supply and demand for a while, or you have just started with it, you have probably found yourself stuck not knowing which zone to choose, especially if you have at least 2 zones which are very close to each other and you know that it's either this one or that one. But which one to choose, and based on what criteria you make your decision to stick to one. Often this will lead you to enter a trade earlier than you should, or you might even place an order in a zone that the price won't visit at all. This can really be frustrating because sometimes you have to wait for a longer period of time for the price to return to your zone and trigger your orders. By choosing the wrong supply and demand zones, you are leaving some of the good trades on the table. So, how can you filter out these supply and demand zones you have identified so that you only pick those which presents a high probability of success? Remember, the goal is always to stack the odds in your favor and not the other way around. The solution is to have a scoring system or a filtering system. Now, the scoring system is based on analyzing 4 or 5 major odd enhancers that I will discuss and to give a final score to each one of them so that it all adds up on a scale of 1 to 10 in total. And this system will help you score the supply and demand zones to let you decide which ones to trade. Okay, now let us visit each of the 5 odd enhancers one by one and set a criteria for scoring on each one. The first and foremost odd enhancer is the strength of price move from the base. Now the first thing to look at is the strength of the move out of the origin or the basing structure. In other words, we look at how the price leaves the supply or demand zone. Was it actually a strong move or a weak move? A strong move is one that is comprised of big candles and sometimes even gaps are formed as the price leaves the zone. On the contrary, a weak move has many small candles and the drop or the rally doesn't go far from the zone itself, or simply the price action is weak. In this chart, you can see that the price left the supply zone with strong bearish candles to the downside, making them very strong zones to trade. You will also notice how the price did not go all the way up to test the supply zones to move down in a strong manner. This shows how great an imbalance is at the supply zone. Now let us take a look at an example where the move out of the base is weak. This demand zone is considered weak because the price left the zone with very small candles. The move out of the demand zone is actually weak, and as a trader you should avoid trading such weak zones because the price will ignore it and most probably the price will pass through it the next time it tests it. In short, if the price leaves the zone with long candles, this means that the imbalance is strong and more unfilled orders are still available at the zone. But if the move from the zone is weakly represented by small candles, this means that probably no more unfilled orders are still there for us to trade. Now based on this first odd enhancer, we can give a score from 0 to a maximum of 2 points. So when we have a supply zone where the price leaves the zone with big candles, this zone shows a high probability of success because of the strength of the price move out of the basing structure. Now the score we will give to this zone is actually 2 points, which is the maximum score, and you will notice how the price drops when it returns to test the zone again. Now when it comes to a weak supply zone, where the price left the supply zone with weak and small candles, what this means is that there are no more unfilled orders that are left to be traded and the sellers are losing interest in selling at this price level. Soon they will be outnumbered by the buyers who will take the control of the market and move the prices beyond the supply zone. So this zone will attract a score of 0 based on our first criteria. Now the same is applicable to the demand zones also. Now coming to our second odd enhancer, that is the time spent at the base. Here we will look at how many candles are in the basing structure. In general, the best zones have between 1 to a maximum of 6 candles in the base. Now beyond 6 candles, the zone is considered weak and the price might ignore it the next time and therefore it can result in a losing trade. So this clearly means that if the imbalance is important enough to generate a directional move, the price has to spend less time at the basing structure. That is why we should limit the number of candles between 1 to a maximum of 6 at the base. Now take a look at this chart. We have a rally base drop structure, but with only one basing candle at the supply zone. This is a very strong basing structure. So we will give a maximum score of 2 for this supply zone. While in case of this demand zone, the price spent a little more time and created a few more candles at the basing structure. So we can give a score of 1 to this demand zone. Now another thing to consider while analyzing your basing candles is the tails or the wicks. Now basing candles with long wicks or tails are a sign of a weak zone. So in this example, the price spent too much time at the base creating more than 6 candles. This is a weak zone because the price did react but failed to move higher and finally it went through the zone to look for another demand imbalance. Now the score for this demand zone is therefore 0. Now let us move on to the third odd enhancer, that are fresh zones. Now a fresh zone is a supply or demand zone that the price has not tested yet. The first retracement tends to be the strongest and the most reliable one to trade. So as a trader, you should always choose fresh, untested zones to stack the odds in your favor. After a second retracement to the zone, it is better not to consider it because there might not be enough supply or demand to move the prices, as most of the orders might be absorbed during the 2 initial retracements. Now look at this chart. We have a supply zone that the price has not tested yet. These are actually good zones to short once the price retraces back to this zone. Now the same thing goes for a fresh demand zone. If the price returns to test it, we look to go long. In the first retracement, the price tested the supply zone and moved down. The same thing happened in the second and the third retracements. But after the third retracement, the price broke above the supply zone, which indicates that no more supply was found there. Similarly, you can notice how the price left the supply zone after the second and third retracement. The strength of the last 2 moves are weakening, which in turn signals a potential shift in the market imbalance as more buyers are stepping in, thereby creating a breakout above this supply zone. Now consider another example where the price broke the demand zone after the second retracement. You can notice how the price penetrates deeper inside the demand zone with each retracement. This is a very good signal that the supply zone is no more valid and a potential breakthrough is expected. Now after the second retracement, the demand zone is no longer valid as the market imbalance shifted from demand to supply. Now in terms of scoring a fresh zone that has not been tested, you can give a score of maximum 3 points. This is the one we need to focus on when trading supply and demand zones in the market. We need to stack the odds in our favor by choosing fresh, untested zones to trade. Now, if the price retraces back to our zone for a second time, we can give it a score of 1.5 points. Now, we can still consider this zone, but again, we will always be looking for high probability trading setups. Now, if the price retraces back again for a third time, we will give it a score of 0 as it has less probability of success. At this point, most of the unfilled orders are already gone and the price might pierce the zone and move away to find another supply or demand zone. The fourth odd enhancer is reward to risk ratio. The reward to risk ratio, as you may already know, gives us a good idea of whether we have a chance of making money trading on a particular supply or demand zone or not. So we need to choose those trading opportunities that offer us at least a 3:1 reward to risk ratio. A ratio of 3:1 is a perfect ratio because we are risking 1 point to gain 3 times. For example, if a trade has a 10-point stop loss, then the target should be at least 30 points away from my entry point. So if the market does not give you a 3:1 ratio, then it is better to stay away from this trade and we will look for another opportunity which offers us a 3:1 reward to risk ratio. But you can also scale it down if you want. A 2:1 ratio is also a good ratio and the trades could work just fine. But again, we are always looking for high probability setups and we leave those with a low rate of success. And a 1:1 ratio or less is considered a non-valid entry since the market does not offer a good opportunity to make money. If the zone gives us at least a 3:1 ratio, we give a score of 3 points, which is the maximum score to this particular zone. Now, if the zone gives you a 1.5:1 or a 2:1 ratio, then we will give it a score of 1.5 points. And finally, if the zone gives us a ratio of 1:1 or less, then we will give it a 0 score because we will ignore the zone and we will wait for another opportunity. Now the last and final odd enhancer that I will be talking about are the overlapping zones. These are also called as nested zones. Now the idea here is to look for overlapping zones from different time frames. For example, if you have a supply zone on a daily time frame that is located inside a monthly supply zone, this daily supply zone is considered strong and it presents a high probability of success. So as a thumb rule, higher time frame zones are much more powerful than smaller ones. So if your lower time frame zone is nested inside a higher time frame one, it is actually a strong zone. So here in this example, we have a daily zone indicated in blue that is nested inside a higher time frame monthly supply zone, which is represented in red. But how to find them and draw them? To find the nested zones, you start with the higher time frame. Now in this example, the higher time frame is monthly. So we draw the monthly supply zone, then we will move to the daily time frame to look for supply zones within the monthly zone that we have already marked. You can also have a daily demand zone nested inside a weekly demand zone and so on and so forth. I hope you get the basic idea. Now, I won't be including this odd enhancer in my scoring criteria because not all levels present such an opportunity and the chances of missing out will be higher if we make it a strict criteria to follow. Now that we have a scoring system in place to help us score the supply and demand zones, we need to interpret the final score to either execute the trade or wait for more confirmations. Now let us say a zone has a score of 10 points. So a final score of 10 points means that we can place a limit order at the supply or demand zone that we want to trade beforehand, so that you will not change your mind for some reason. Now this order will get executed once the price reaches 10 pointer level, namely the proximal level of the zone. But make sure you place the stop loss order at or beyond the distal line to protect your position. Now this score of 10 shows that the zone is a strong zone, fresh with less than 6 candles at the base and giving us a good reward to risk ratio to make money. Now what if a zone has a score between 8 and 9 points? Now if the score is between 8 and 9 points, we can think about a confirmation order. Actually, a confirmation order is an order placed when the price first dips into the zone of interest and crosses above or below the proximal line of the supply or demand zone. So the idea is to confirm that the price is moving in our preferred direction of trade. So any one candle has to close inside the zone first, and the second candle on its way out has to pierce the proximal line of our zone. Now the moment the price pierces the proximal line, we place a market order. Here we don't place a limit order because the odds are not completely in favor of us. The stop loss order setting is standard as always. And finally, what if we get a score of less than 8 points? Now if the final score is below 8 points, it simply means that there is no trade. The supply or demand zone with a score below 8 points is actually a weak zone that has a low probability of success. So it is better you avoid taking the trade. As I have mentioned earlier, you can read more about other odd enhancers in the link provided in the description, and you can be flexible enough to change the criteria and scoring according to your convenience. Now with that being said, the odd enhancers we discussed here are very important tools to help you filter the supply and demand zones. In addition to that, the 4 odd enhancers used in this filtering system are what you need to score your supply and demand zones. This will further help to fine-tune your filtering system. But remember that these odd enhancers don't guarantee the success of your trade. Instead, what it does is that they give you a better chance of taking the right trades when they show up and leaving the ones that have a low probability of success. So it is up to you to do your research, learn more, backtest on multiple charts, and finally implement